Hey Glendora, so the short answer to that question is jobs. Basically, the Fed is tracking inflation and jobs and the economy as a whole. And then the mortgage rates are affected by the market sentiment, not necessarily Fed policy in this case. So what happens is that the Fed projected over the last few months that they want to lower rates before the end of the year. So the market priced in 1% decline in interest rates. Rates came down 1% since the Fed started projecting it. You see here, we're up in the 7.5 range, and we went all the way down to 6. That's over 1%, okay? And then what happened in the last 2 weeks is that the September jobs report came out stronger than expected. You'll see here that the report added 254,000 jobs in September, far surpassing expectations. And the revisions to July and August also added $72,000 to the previous months. This is the highest single month job gain since January, and it has reversed 5 months of declines in the 3-month moving average. As you'll see, this red line has finally turned positive. That's the 3-month moving average of new jobs. The blue bars are non-farm jobs, and the red line is the 3-month average of non-farm jobs. Furthermore, the unemployment rate has decreased from 4.2 to 4.1%. That means less people are requesting unemployment insurance. Less people are filing for unemployment. That means the economy is stronger than expected. And when the economy is stronger than expected, then the market has less of an expectation for the Fed to reduce interest rates further. So if the Fed projected interest rate declines earlier in the year, as I showed you in this other graph here, and then the rates came down 1% or more, and now this week the economy is stronger than expected, the market now believes that the Fed will not, or there's a higher likelihood that the Fed will not reduce rates further in the next meeting. So that's why rates bounced right back up 0.5% to where we are now in the mid 6s plus or minus. That is why the rates bounced up. It's based on the market expectation because the economy is stronger than we had anticipated. Now the question is, how does that affect you as a buyer or seller in Glendora today? Well, as a buyer, you're going to have to pay 0.5% more for your mortgage than you had to 2 weeks ago. I'm sorry, it's just the reality. However, the good news is that the reason you have to pay 0.5% more is because the economy is stronger than expected. So that should give you hope for the future, that when you do have to turn around and sell your property in the future, there should be a ready, willing, and able buyer behind you, qualified to buy it at the same interest rate or same price or higher as to what you paid. So that's, it's a double-edged sword. Your payment's going to be higher, but the economy is stronger, so that's good. Now, if you have to sell your house in Glendora, expect the buyers to be more payment sensitive, more price sensitive, for 2 reasons. Number one, their payment just went up. Their interest rate just went up 0.5%, so their payment went up. And number 2, it's the second half of the year. It's holidays. People are getting distracted. They're thinking about next year. So buyers, I wouldn't be scared because the economy is strong and that's good. Sellers, I would just be cautious. Try not to overprice your property. Price it aggressively in a way that will attract the right buyer today. Let's look at the stats real quick. Okay, we've got active listings climbing. We've got new listings declining. We have days on market climbing. That means taking longer to sell. We've got months of supply climbing. We've got price per square foot declining since May. I'm not worried about the decline, but it's because it's cyclical. You'll see here, this is the last 5 years, but if you look at the last 15 years, you'll see this regular curvature in the graph. That means typically in the second half of the year, prices soften. It's very typical. It doesn't necessarily mean there's any sort of crash. It's just a cyclical decline. So don't be too aggressive on your price if you're trying to sell your property quickly before the end of the year. And percent of original list price. Right now we're hovering around 100%. That means sellers are getting what they're asking. It doesn't mean they're getting what they're asking if they overprice their house. It means they're probably being more reasonable with their ask. And then buyers are like, yeah, I'll buy the property for that price. And so that's it. Days on market increasing slightly. Here's go. Price per square foot. If you're buying, your payment's gonna be a little bit higher, but the economy is strong and that's good. If you're selling, the buyer is gonna be a little bit more sensitive. So talk to us about what we think might be the right pricing strategy to get your home sold quickly. And if you're ready now, call us right away before the holidays. If you're thinking about next year, call us so that we can help you prepare and be ahead of the curve and have less last minute scrambling. I hope this was helpful for you. Please feel free to subscribe to stay tuned on our social media. God bless you, and reach out anytime with questions. Take care.